All right, everybody. Like I said, I am so excited to have Chandler Wrightenberry on the show with us today. And Chandler, as you may know with Hey Docs, I really love for my guests to tell us just a little bit about themselves, how they got into the industry that they're in. So I'm going to let you just take it right away and give us, the quick synopsis on you and how you got into banking.
Yeah, absolutely. Thank you so much for having me on this podcast. I'm excited to be here. My name is Chandler Wright. I work for Live Oak Bank. And so Live Oak Bank is actually headquartered in Wilmington, North Carolina, but we're a nationwide lender. So how did I get into the business? Actually, in 2014, when I graduated college, I actually came down to Live Oak Bank to start for my first job in a servicing role.
I did
So
not know that. That's
yeah.
great.
So that was 8.5, almost 9 years ago. So I've been here my whole career. So when I started out, I was in the servicing unit or the servicing business, and I was actually covering a portfolio in the Northeast of pharmacies. Did that for about a year, then moved over into underwriting for the bank. And for the past 6 to 7 years, I've been on our healthcare lending team and primarily focusing on dental lending.
Oh,
So been here almost 9 years. I can't believe it. It's been
what
fast.
it's amazing how quickly things go in our industry and what a great path to have been with the same company. And it's always my favorite when somebody works their way up through the company. Now you're at where you're at. That's pretty exciting.
Yeah.
Congratulations.
Thank you. Thank you so much. And it's been wonderful. I've enjoyed the ride so far, and I love working within the dental industry and obviously here at Live Oak Bank, where they take really good care of us.
Yeah, that's wonderful. So let's jump right in. And one of the reasons I wanted you on the show is I know you are a go-to for me when I have docs that are looking to do any type of lending, especially when it comes to, purchasing a property or purchasing land or, ground up type of a thing. So what I want to do first is maybe for some docs that are out there listening and they're testing the waters and saying, what do I want to do? It all starts with banking, as we know. Usually I say demographics and then banking. But can you talk to us just a little bit about the differences between a conventional loan and an SBA loan, and maybe what my docs might not know that they need to be aware of when they are considering bank loan?
Yeah, absolutely. I think that's really a good starting point. Let's just go back to the basics and
Yeah.
understand what type of lending is out there. And there's no dumb question, right? Like you coming out of school or you're early on, you're not an expert in banking. You might not know that, right? And it's not a dumb question to ask what type of loans are out there, what is out there for me to be able to potentially start up my practice, acquire a practice. So taking a step back, let's
Mhm.
talk about SBA. Let's talk about conventional. So here at Live Oak Bank, we're actually predominantly an SBA lender. That's really what I am focusing on. So maybe I'm a little bit biased and I have a little bit more expertise within the SBA field, but SBA lending. So what does that mean? Small Business Administration. So back in 1953, that's when the SBA got started by, I think it was Dwight Eisenhower. So it was a way for the government to get involved and provide capital to small businesses all across the country, 28, 29 million small businesses. So government probably not as efficient to be able to lend directly to small businesses. So what they did is they championed a program to be able to provide guarantees and work in conjunction with banks all around the country for the banks to provide that capital. In return, what does the government do? They provide a guarantee for that loan, right? Hey, we want to get capital into small businesses' hands. So we will provide a guarantee to that bank to go make a loan. So with that being said, that's great. And so SBA, Small Business Administration, small business loans, there's two divisions, 7A, 504. We won't get into that. But they provide, yeah, keep it simple. They provide more, at the end of the day, provide, I think, more flexible terms. Okay. So think less money down, longer terms for amortization. So the repayment of that loan could go out to 20, 25 years, maybe less collateral requirements, and also no balloons or demand payments. Okay. So that is a summary of VA lending. Is a little bit more flexibility. Now, with that flexibility, with a product does require potentially higher because there is a guaranteed piece to it.
Sure.
And the government is supporting that. And so there are fees that are a little bit higher, usually around 2 to 2.5% of the total loan amount is what you can think. But at the end of the day, it's really a product that provides flexibility. It's not the product for everybody. It makes sense in a lot of situations.
Sure. And would you say you see more SBA loans when it comes to a property or a practice purchase per
Yep.
se,
Yeah.
or versus with startups? Or can you kind
Yeah.
of talk to that a
So
little bit?
I think SBA is usually a better fit. And what we see is for an existing doctor that's looking to take on a larger project.
Yeah.
So let's say, hey, I'm an existing doctor, been in business for 10, 15 years, and I want to go over and buy the commercial real estate that's down the street or do a ground up construction project. That's really where we focus on. And I think that's where the product fits well. Because at that point in time, these projects in today they're expensive. Nothing's
And
cheap
take
out
a
there
while.
anymore. And they take a while. So that is inherently a riskier project for the
Yes.
bank.
Yeah.
So that bank is taking on more risk. So if that bank is taking on more risk, they want to guarantee and support from the government. But that product does allow for longer terms, more flexible down payments. And that's what you need when you're taking out larger loans and more risky projects.
Yeah.
So I think for more experience later on down the line, SBA is a really good fit for larger projects, but it can also be a fit. And we've worked on projects together as well for doctors that are looking to start up with commercial real estate, because your down payments are going to be a little bit less than a potential conventional loan when it comes to commercial real estate.
Yeah.
That down payment flexibility is really important.
Yeah. And speaking of projects that we've worked on together, I think it's good to know that a lot of times a doctor could have two different loans going at the same time. So we could have the SBA that's going for the property, and then we could have a commercial that is funding our startup. And they could have different terms. They could be doing everything, but they marriage really well together. And maybe you want to talk just a little bit about that and how that works from a banking standpoint.
Yeah, absolutely. So I think we live in this little small world that's a little bit different,
Yes.
and it's a great industry to be in. So just like you said, yes, we've absolutely done projects together, partnering with other conventional or traditional lenders. And that is an option that's out there, right? So conceptually think, hey, we would go and finance the commercial real estate on an SBA note. And then we could work with another traditional or conventional lender for them to come in and do all the tenant improvements, all the equipment, and all the working capital. So now you're getting the flexibility and structural creativity for commercial real estate for a longer term that helps your cash flow, right? Lower that monthly payment. And then everything that's built inside of that facility is on a shorter note, but really good terms that you're going to get out there. I think that's a really cool product. But what I always recommend is talk to multiple banks.
Agreed.
Go talk through it, ask for transparency, ask for the right questions, but always work with multiple lenders would be my recommendation. Even though I'm a lender, I wish you to come work with me.
Yep.
But I think it's really good. Concentration risk is a real thing. And so you don't want to put all your eggs in one basket.
Yeah. Yeah. So if you were to, just give 3 highlight points to what do you think docs should be aware of if they're looking at an SBA loan or they're looking at a commercial loan? And I know you just touched on a few of these, but what would be, I don't know anything. Chandler, you're telling me, you're giving me my bumpers. Tell me what I need to be aware of.
Yeah, I think what you need to be aware of, first off, you got to ask the question, what are you doing? Okay, so number one, are you starting up?
Mm-hmm.
Okay, I think that goes down the conventional route. I think there's really good products out there conventionally for doctors coming out of school or looking to start up their own practices a few years out of school. Conventional route is usually going to be the best route. Are you looking to is that startup, leaseholder, is that a building? Acquisition. I really think conventional financing is a good option for that as well. There's so many lenders out there that do conventional financing for doctors, startup or acquisition wise, that have really competitive rates and really good terms. Are you looking to expand? Okay. Have you been in business for multiple years, just like we talked about earlier? Are you looking to expand and get into commercial real estate ownership, do ground up construction? I see it in phases. Yes. So you got to ask that question first. At that point in time, I think SBA can be a really good fit, right? Because these are going to be larger projects, more flexible down payment requirements, and then longer terms, which help with your cash flow. And I know you talk to all your clients about cash flow and how important cash flow is. And what is cash flow? Yep. Simplicity, profitability minus all your dets. And if you're making more on top of that, your cash flow, and that's what you're going to be taking home. And so cash is king right now in a society like this. Does that help? Does that make sense? Does that help?
Yeah, I think that's great. It just super simplistic, but breaks it down. And I think that just helps. I believe you've really been able to just help us, understand, okay, because what I see a lot and I hear a lot is there's a lot of chatter out there in the groups and, this, that, or the other. And all of us can get a lot of advice from everybody. And sometimes the advice isn't always the best advice, or it
Mhm.
worked well for them, but there was a circumstance in which it worked. So I think you just being able to break it down a little bit. If we're buying a property, if we're buying land, if we're buying a building, probably SBA
Yep,
makes a little bit more sense.
I
If
think
we're
so.
just doing tenant improvement, building out a space, maybe a commercial makes a little bit
That's right.
more
Oh,
sense.
oh,
And they can be mirrored together in certain circumstances, which can be really beautiful as well.
that's absolutely right. And the thing is, obviously, I'll provide my contact information after
Mhm.
this. I'm always an open book just to have an honest conversation. I want to be honest and upfront with everybody on a first phone call. And
Which
as
is
you've,
why I love you, which is
yeah.
why I love sending my clients your way, because you're going to tell it to them straight. And I love
Yeah.
that.
Because we don't
Yeah.
want to waste anybody's time. You don't want to waste anybody's time because the time's the most important thing that you have. So let's get straight to the answer. Let's keep it clean. Let's keep it concise, and let's get you in the hands of somebody that's going to be able to take care of you.
Yeah, yeah, that's great. So let's talk a little bit about, we've decided to move forward with a loan, and what let's talk a little bit about qualifying in
Mhm.
terms of liquidity and cash flow. What exactly does that mean? Because those are terms that get thrown around, and again, these are all things that I think, unless you've done this or been down this path, it can sound a little daunting when you start to
Yeah.
hear these phrases, and what does that mean and how does that affect me? So can you talk a little bit to that as we kind of shift gears just a scotch here?
Yeah, certainly. Every project's going to be different. Every product, every lender might have different criteria for
Mhm.
their approval process or their underwriting process. I think a general criteria, I can summarize it in about four things. And I think
Yeah,
this is
that's
a
great.
starting point. And so, number one, it's self explanatory, but have great personal credit.
Yeah.
Okay. Anything above 700, I think, is fine. That should
Mhm.
be okay. No late payments on cards. Okay.
Mhm.
No late payments on mortgages, no late payments on auto loans. And another thing that's really important that is a big time factor in your credit is your evolving usage, like on credit cards. So, hey, let's say I have a $10,000 credit limit on a credit card. Don't run that balance at $9,000. That's
Yeah.
going to make your credit score go down. Keep your balances low, make your monthly payments every month, pay that credit card off. So, great credit. That's the starting point. Liquidity wise, again, this goes back to what type of product are you using? How
Mhm.
much is required
Mhm.
down? I think a good rule of thumb, you can never have too much cash
Yeah.
and save. Just continue to save. But, I think a good rule of thumb would be probably anywhere from 10 to 15% of the
Mhm.
total project cost.
Yeah, that's
I think,
great. And I just want you to say that one more time, about 10 to 15% of the total cost. So again, let's say we're buying, $1 million piece of property, 10 to 15% of that is probably what we're going to need. Let's say we're
yeah,
doing a $800,000 startup. It's good to have 10 to 15%. Now, again, depending upon, like you just said, the loan, the lender who we're working with, that could vary a little bit. But I think just having these little benchmarks for
yep.
doctors to put into their minds is so helpful to, as you're moving down that path of, should I do this? Should I
Hmm.
not do this? So that's really good information. And I get asked this all the time.
Yeah.
And I do want to bring up something that I get asked a lot, because I have a lot of docs talk about student loan debt and how does that affect my credit. And you may be only able to speak for your bank, but how does that impact a doctor? Is there a tipping point where too much is too much, or are there other factors involved that go along with that?
Yeah, certainly. And so I don't want to speak for other lenders. And I could, like you said, I can
Yeah.
speak for my lending criteria, but we understand for you to take on this risk, right? You have to go through the school and you have to take on that debt to be a doctor. So we
Mhm.
understand that there's going to be student debt associated with your profile. That is not going to deteriorate us or deter us, I should say, from pursuing a project or lending to you,
Mhm.
right? We understand that you got student debt. We understand that you have a mortgage. You understand you have a car, you have kids, right? And so that is a piece of how we evaluate the underwriting process. So we understand that there is going to be debt associated with a project. It's student debt, and some of them are larger than others. Like you're getting up to million and a half, that's probably an issue.
Yeah.
But anywhere between, $500,000, $400,000 and below, we can get on board with that. And usually Most of this debt is income-based repayment. So when we're going through the underwriting process, you're actually paying less than really what that payment should be, right? Because of the income that you're drawing in, and they're going to step that up as you continue to make more income. So it's not going to deter us from making a loan. You can have student debt. We understand that's part of the process. That's part of where you are today and getting to where you are today. Does that help? Does that make sense? And I don't think there's a number, but logically think, hey, if it's really high, that is going to be a little bit tougher for maybe a lending institution to get on board with.
Sure. And I think that kind of leads me right into what I think so many docs want to know, that debt to income ratio. How does that work out if I'm coming out of school? How does that work if I'm an associate somewhere? How does that work if, so can you talk to that again? I know very generalized, but I think that it's something that people are always wondering, what is there a magic number out there? Is there a magic ratio?
Yeah, absolutely. And, here we don't look at that as much, but I think a really good number to focus on, because I still pay attention to it. Like, it's not necessarily into our underwriting decisioning and credit decisioning, but 30% debt to income ratio. I think keeping that 30% or below. And so what does that mean? Okay, let's walk through that. Okay, if you're making $10,000 of gross income a month, your net outflows need to be $3,000 or less. So your mortgage payment, your car, your auto loans, your credit cards, try to keep it below that 30% range. And I think that's really healthy. When you really think about it, if you can reduce your debts as much as possible and maximize your income and production, you're going to be a lendable candidate.
Yeah.
Just keep that debt as low as you can, but understanding that, yes, we do have student loans, we do have mortgage, we do have credit cards. Does it make sense to go out there and buy a car that's going to be $1,000 a month payment, $1,500? Potentially not, if you're going to go do a larger project, or you're looking to start up your business. It's just things that are necessities and things that may be a little bit extravagant that you might not need.
Yeah. And I think that kind of leads me into, I get a lot, should I buy a house before and again, I know I'm talking a lot about younger docs and startup docs, but I think this is, these are the questions that, my doctors have. Is it better to buy a house or not buy a house? Is it and I think you just alluded to the car thing. I think what I'm hearing is it all has to do with that debt to income ratio, but is that correct?
I would say so. Everything can go back to that debt to income ratio, right? We want to maximize our production. We want to maximize our income and keep those debts lower. Now, can I tell you, or should I recommend that you go buy a house or not buy a house? That's really up to you, right? If we're really looking at the monthly payment of your debts. Okay. So if you said, hey, I'm renting a house for $1,000 a month and I'm going to go buy a house, and now it's going to go up to $4,000 a month, that's going to impact how much the loan is going to be able to, or the lender is going to be able to approve you for.
Sure.
So is that something that, what I always say though is have honesty and transparency with your lender.
Yes.
Hey, just like you asked that, right? It's like in the beginning, I'm thinking about buying a house right now. Okay. I've been renting for 2 or 3 years. I want to go buy a house. Should I do that right now? Let's talk through it. Okay. As your income is continuing to increase and your monthly payment from a rent to a mortgage is not going to change that much. Lender should be okay with that.
Yeah. Yeah.
But it's the honesty and transparency up front, and we'll work through and be candid with you.
And I just want to say, I think that's the importance of working with good lenders, to why I have appreciated working with you and Live Oak. And we've had a long relationship over the years, is because I know that my docs can call and can talk to you or anybody in the bank, and I know you're my primary, point of contact, and there's no judgment, and they can say what they need to say and get the answers that they need. So I think the point is well taken, that you've got to be transparent if you're looking to go down this road, so that there are no whammies that sneak up on you.
Not a couple of weeks before closing, we pull the credit report and, oh my God, you did just buy that new Mercedes or BMW, or you did buy that big expensive house. And we could have had this conversation early on, because now I got to go back to my credit team and have a conversation, which is the conversation that I don't want to have, or anybody wants to have. It's difficult. It's a difficult one.
Yeah, for sure. For sure. So let's switch gears again and talk a little bit about maybe how you guys view or think about the differences between ground up projects or more of the I'm going to say tenant improvement, but I'm thinking more tenant improvement. We're buying a building and we're going to improve that space. So we are maybe potentially that doc that's been in the industry for a while, and I tend to find that it's usually that 8 to 10 year mark where my doctors are saying, okay, my lease terms are about up.
That's exactly
I've
right.
paid off my first loan. I've got good money in the bank now, and now I'm ready to find my forever space. And so we're making that move. So let's talk a little bit about that and what you see from costs, what you think docs need to be paying attention to. And I'm going to say this because I feel like so many times my docs think it's just the cost of the building. But it isn't just the cost of the building, and there could be a lot of things that we need to think about. And I'm going to throw you one more whammy.
Okay,
I
throw me a whammy.
also want you to just talk a little bit about what if the building that you're buying has the potential for rental space too, and how does that affect everything?
Okay, cool. Yeah, two-part questions. Number one, what?
Thanks, Jill.
Thanks, Jill. Number one, what are costs that we are seeing for maybe that more established doctor? And so you can almost relate it back to the doctor that's looking to do a startup leasehold expansion. It's the same thing, that startup leasehold build out.
Yeah,
it's kind of the same concept. So all across the country, it really just depends on where you're. If are you going to be in the Bay Area?
Yeah.
Or are you going to be out in Kansas, Wichita, Kansas? That changes. But costs that we typically see are anywhere from $175 to $225 a square foot.
Yeah, that's exactly right where I'm seeing that too. Yeah.
For TI work. So that's not inclusive. Tenant improvements. That is not inclusive of the building purchase. The building purchase is on top of the TI, the tenant improvement money. So if you go buy a building for $1 million, 3,000 square feet. Let's just give an example because I know you're out there in Denver and I covered the Denver market and the Colorado market. You were seeing around $200 a square foot.
Easily.
3,000 easily. And you can run it up as high as you want to if you want.
Yes. That's just like baseline, not going crazy with your improvements, just a baseline, good space.
Yep. And so that right there, you got 3,000 square feet. That's going to be $200 a square foot. That's going to be $600,000 of tenant improvement money that you're going to need. Mm-hmm. But also, I like to also break it down even further than that. We're not going to get too in the weeds, but hard cost and soft cost. You got to think about those, right? Hard cost and soft cost. What we just spoke about are hard cost. That's going to be $600,000. It's actually going into that building for tenant improvement work. But what about the planning, the architectural, the permits, that stuff that's on top. So in addition to that $600,000 that you're going to be put into that building, you should be estimating another 5 to 10% on top of that.
Sure. Yep, for
planning and permits, right? Is that something you think that's accurate? That's what we see on our end.
Yeah, for sure. And then you add in your equipment because maybe you take your equipment with you. Maybe you don't. Maybe it's time for an upgrade.
That's exactly right. That's exactly right. And so then that also goes back to the product and what you need. And okay, you ready to, what product do you want for this? Do you want a longer term to stretch everything out? But hard cost, soft cost, you should be looking at anywhere from $175 to $225 a square foot on the hard cost. I would say anywhere from 5 to 10%, depending on if you're just doing TI or if you're doing ground up. If you're doing ground up, obviously those soft costs become a little bit more expensive.
Yeah, that's great. And I think that just helps break that down just a little bit, because again, I feel like it's really easy to get swept up in I'm buying a building and, maybe it's already built out, or, it was a dental office and I'm going to make an ortho office into it, or maybe it's not at all, but there's two different components of costs that we're dealing with. How about a ground up?
Ground up, again, just really depends on where you are located in the country. I'll speak to Colorado, Denver market, just because it's right there in your backyard. But we're seeing anywhere from 400 to 450 a square foot of hard construction costs.
And that's the shell of the building.
So that would actually include everything, but that's not inclusive of the land. So that 300 or that 400 to 450, and you can maybe get a little bit lower than that, is actually going to get you the built out dental suite, not including equipment, and that's not including land or the soft cost. Yeah. So that's what you should be budgeting for that.
Yeah, that's good.
And then, if you go through the Midwest, it could go a little bit cheaper, but I would say anywhere from 300 to 450 is what you should be thinking for that in hard cost.
Yeah. So if a doc is looking and they have an opportunity to buy a building and they have an opportunity, I'm just going to circle back around to this. They have an opportunity to maybe it's got some leasable space in it already. Does that kind of figure into your decision making as well? If there's tenants in there or not, if they're going to put tenants in there, any insight or little
Yeah.
tips
So,
there?
yeah. So, our underwriting criteria, and I would imagine most banks are, but I'll speak for ours, is that we actually do not look at rental income when we are underwriting an opportunity. And you ask, why would you not look? I actually have a tenant over here that's going to drive income, that's going to lower my monthly payment. What we're going to look at is the most conservative scenario. If that
Sure.
tenant is not there and you lose out all that income, can you cash flow this debt at an appropriate
Great, great
level
information.
to be able to make your loan payments?
Sure.
And that's the way that we're going to underwrite and review it. Now, if you want to go be a landlord with our product, usually it's a 51% occupancy rule, right? So you have to occupy at least 51% owner occupied. The rest of the 49% can be leased out in perpetuity. Ground Up has some different rules. But if you want to go be a landlord, absolutely you do that. And that's just icing on the cake. But the bank itself is not going to underwrite that tenant income.
Yeah, that's great. Such good information because again, I get asked that a lot and I really haven't exactly known how that plays in. So I'm sure there's a few docs that are out there listening going, "Oh, good to know."
Yeah.
Which
Yeah.
totally makes sense. You got to, you can't just hope that somebody
Right.
else
Because
will be able to help you make your payments. So,
that's exactly right. Because what if that tenant defaults or that
yeah.
tenant goes out of business? Because now you become a landlord, and the things that you got to think about is, okay, how are you going to improve that space that's next door? Now you're a
Mhm.
landlord, you're going to have to provide tenant improvement, which you're familiar with all the
Yes.
startups, the landlords that have
Yes.
provided them TI allowances of 10, $15 a square foot. Now that's exactly what you're doing. So
Yep.
that's another headache to the business. So it can be done. It can be income stream for you, but you just got to think through the whole dynamic.
Yeah. Yeah. And I would assume in most cases there's levels to, this is a different level than being a startup, probably not what you're going to
Yep.
want to do first thing if you've never owned a business. You're going to be working into these things as you figure out what your investment strategies are going to be as you're going through your careers. So
That's
that's
exactly right.
yeah, that's such good information. Thanks for letting me ask, leading us in a
Yeah.
little bit of a rabbit
You
trail there. But,
You're
I
welcome.
figure I got you on this. So I'm going to ask all the
Yeah.
questions I get asked. So let's talk a little bit. I know you don't know the future, but how's
Maybe I
it?
do.
Yeah, I hope you do. I hope you do. Any insight on inflation or rate forecasts or what you think it's going to do to us in this next year? I know everybody's asking. Maybe you've got some insight. Maybe you can give us
I
a
wish I
snippet.
did. I wish I did. So, I mean, that is the hot topic right now. That is everything that you see within the news.
Yeah.
Everything is highlighted with inflation, and it's obviously a hot topic, and it's important, and it's something that we should be paying attention to. I don't know if you can share information after the fact of this, and we can give you some charts and stuff like that for your
Yeah. I think
listeners.
anything you want to send us, we can add.
Absolutely. Because I have something I'm looking at right now. So I actually have a summary of the economic projections from the Fed's last week. So they're meeting, on a monthly basis, and then on a monthly basis or every couple months, they're coming out and determining whether they want to raise or lower interest rates. And obviously over the last, 6 to 9 months, interest rates have continued to rise due to inflation. What I'm looking at right now, like I said, we will be able to share it with you, but the Fed's funds rate right now is around 4 to 4.25%. And their economic projections are showing that potentially rises closer to 5%. And then through 2023, 2020, or 2024 to 2025, that starts to come back down.
No, good. That's encouraging.
So that's encouraging. That could totally change, right? Because actually what the Fed is doing is they are looking at historical data about inflation. And so they have to make their decisions on what's happened over the last 3 months prior. So this is a total economic projection, but there's a lot of things that factor into it. But what I would say is, do you think we're closer to the top? I would say so.
Yeah. If that's a question to me, I would think so as well.
Do you think we're closer at the top or we're still at the bottom, right? Because they've raised rates almost 4%, 4.5% this year. So I would like to say, hey, we're potentially closer to the top than we are at the bottom. It's a good thing. Hopefully there's a pause coming. So I wish I knew. I don't have any idea of where it's going. Inflation is cooling, right? Every time they come out with a report, there are indications that inflation is coming down. So that would also lead to potentially the Fed to stop raising rates at such a rapid pace, maybe stabilize. And then you really just got to see what the labor market is doing.
Yeah.
Right?
Yeah.
That's really the weird dynamic here.
Yeah. And, having been in the consulting field for the last, 18 years now, which is really crazy to think about. One of the things that, comes to my mind is I have seen interest rates high,
Yep.
way higher than even where I'm higher than 5.5%.
Yep.
And I've never seen them any lower than what we saw through COVID. And so the one thing that I would say, working with startups and doctors across the United States for so long now, is we've never not been able to fund our projects or not been able to get lending for our projects.
Yes.
It's just a matter of, if the way I look at it, if we are taking on a loan that's maybe got a higher interest rate, what are we going to do when the interest rates come down? We're going to look to refi.
That's exactly right.
And I think the people that were lucky enough to lock in stuff low, they probably aren't looking to refi.
Yeah.
But I think that, this funding wheel is going to continue to turn. And I guess I would tell any docs that are out there, do we do something? Do we not? This is not anything new. This fluctuation happens. It just is something new for this year, this time of our lives. But if we were to look historically,
it ebbs and flows.
Yeah,
right. It ebbs and flows. And I got some other charts that I would love to share with you that you can share with your listeners. It's looking back, and you got to take it. We're looking at the last couple of years.
Yeah, such a microscopic look.
I'm looking at a chart right now of the last 50 years for the 30-year mortgage or the 10-year treasury. Yeah. Rates were in the 10-year treasury, or mortgage rates were in the 1980s, 17.5%, 18%.
Can you imagine? I know, I've been married 31 years now. When my husband and I first got married and we bought a house, we were buying at 12%.
12%. Yeah, 12.
12%.
And it was higher, than that before
it. I mean, we thought we got a deal. Now, of course, what do? We refied, and over things, time.
Ebb and flow, just depending on how expansion, contractions. And the big scheme of things, what we're trying to say here is, right, over the long haul, rates are still very reasonable and low right now.
Yes.
Have they shot up 4% this year? Absolutely. But when you look back over the last 50 years, that's still probably below the running average. The 50-year moving average would be my guess, are very close too.
Yeah.
And when you're in the healthcare industry, in the dental industry, there's more banks out there than ever lending to this space.
Yeah.
And competition creates better pricing, right? If more people are going after something, they're going to create better pricing. So rates right now, I would say across the board, high fours in certain areas, up to 7 or 8%. So anywhere from the high fours to the 7 to 8%, I still think that's very attractive. If you got something a little bit higher, you always have the ability to refinance in the future. And always what I like to pose the question is, this is going to be a 20 to 30-year investment for you. If not, can't think about the short term. It is a little choppy right now. It is a little uneasy, and it's a little unsettling where the markets are, how the economy feels. It's just a weird time. But you got to look in the long term.
Yes.
And also, do you think you can return more than the 5 to 6 or 7% that you're going to be paying in that debt? Because this is good debt to take on, right? Mm-hmm. Generating revenue.
Yes.
If you could take on debt, good debt is when you're able to generate revenue at a very reasonable rate.
Yeah.
I'm just going to ask that question to you, and hopefully you're going to say yes.
Oh, I completely agree. And what I tell my docs is, it's like an investment strategy. You're investing in yourself for your business, right? So you've got that modality. And then if you have the opportunity to, so just that investment and the loan that goes along with that, 10 years that's paid off, you should be doing very well. If you also then have an opportunity to invest in a property or to invest in a building, that's a whole nother piece to add to your portfolio, so that when you are at a point in your life where you're ready to retire, you're not just selling a business, you're selling property, or maybe you're holding on
to it and renting it out
and keeping. There's just so many opportunities if you're willing to take the risk. And I think what it comes down to is there's always a little bit of a risk. There'll never be a perfect time. I don't think.
Can't time the market. Do not try to, don't think that you can time the market.
Yes.
Don't think you can time the market.
Yep. Yep. That's great. Chandler, this has been phenomenal. You're just,
Yeah.
as always, a wealth of knowledge. So if somebody wants to get a hold of you, they want to call you, they're dreaming, they're thinking, they're going, gosh, this podcast is coming at the right time. What's the best way for them to get a hold of you to find out more about Live Oaks, all of that?
Yeah, absolutely. So I would love to share my cell phone with you
That'd
along
be
with
great.
my work email address. And so if we
Yeah.
can include it within the podcast
Yep.
or you can share it with your listeners, I think that's the easiest way. I would love for an email to be sent to me or even better, a phone call. I have my cell phone on me all the time.
Great.
And, a little bit different time now since I got the children, but around the clock, I'm always paying attention to my phone and always happy to answer any questions that anybody has, especially if they're coming from you, Jill.
Yeah, perfect. That's great. So if they want to get on the website to find out more about Live Oaks, or if you want to just say at least your email so that if somebody's listening and they don't jump into the notes afterwards.
Yeah, so it's going to be chandler.wrightenberry@liveoak.bank.
Perfect. Nice and easy. Nice and easy.
Life
Great.
easy. That's perfect. And you can always go to liveoakbank.com and go into the loans section and find dental.
Yeah, that's great. Again, Chandler, thank you so much. This has been so informative.
Thank you.
As I like to wrap up our Hey Docs, I always like to do a little speed round. So
Let's do it.
Are you ready?
I'm in. I'm ready.
Okay. All right. Coffee or tea?
Coffee.
Do you have a favorite book?
I do. It's one of the ones I recently read was A Billion Dollar Whale. I like financial crime.
Oh, I love that. I'm
really
always looking to keep a running list of books. So I'll add that one on.
It's a
Favorite
good one.
outdoor activity?
I like golfing or getting out on the boat on the ocean.
Ooh, nice. All righty. If you could be remembered for one thing, what would it be?
I got to say this is a little sentimental, but being a loving and caring father, because I just welcomed my 2 twins on Christmas night. I'm a first-time father.
So exciting. Twin babies on Christmas.
Twin baby boys on Christmas. That's right. Best Christmas present ever.
That's wonderful. And then best piece of advice you've ever received?
Best piece of advice. Okay. God gave us 2 ears and 1 mouth for one reason, to listen twice as much as we speak. So hopefully I listen more on this podcast and hopefully I'll be listening to your clients.
Yes. Oh, I have no doubt about that. Again, thank you so much. I really appreciate it and love to have you on again.
Awesome. Thank you so much, Jill, for having me on here.